Hello, everyone. Um, Last time we finished our portfolio theory lecture by talking about three major anomalies: the PE ratio anomaly, the size anomaly, and the book to market ratio anomaly. There is a fourth one that is actually quite important, and actually people in the industry use it to make money. In essence, some sort of active portfolio management would imply, okay, once you see certain signs, you gotta rebalance your portfolio in order to take advantage of the signs. Okay, let's see what those sign is, and how it works. So this is called the post earnings announcement drift. So let me first give you the idea. So the idea is you have quite a few number of or many analysts looking at a certain stock, right? So once it's getting close to the earnings announcement date, right? It's like a quarterly announcement. Um, these analysts are going to have forecasts about the earnings of that particular company based on the prospects of the firm in the future and how they did in the past, or whatever model they use. They will have forecasts about the level of earnings per share for a particular company. Okay, which means that, for example, if you have 10 analysts looking at a stock, you're going to have 10 different, possibly different forecasts about earnings per share of that same stock. Agree? Okay. Now, you can actually look at what the average is and take the average as the consensus about that firm's expected per share earning. All right? Now, once the firm announces the earning per share, you can go back and compare the actual earning per share to the forecasted earnings per share, right? There's going to be a difference. Agree? Now, if that difference is positive, we're going to call it a positive surprise earning. If the difference is negative, we're going to call it a negative surprised earning. All right? So in order to make an investment decision, right, you basically want to say, well, I want to invest in stocks with positive surprise earnings and short sell stocks with negative surprise earnings. The rationale is that there is this anomaly, right, magical thing that exists that you're going to make money if you do this. But if markets were efficient, you would expect that, well, once the announcement is made, all the information is impounded in prices. And the only thing that would happen is that a surprise earning is going to either shift the price up if it's positive or shift the price down if it's negative. And then the price remains there thereafter. There's not going to be any changes. But the data actually shows that it's not true. And there is some anomaly there that people actually could use to make money. So in order to actually show it, we need a standard notion of earning surprise. So what I described would help us calculate the actual level of surprise and earnings per share. But in order to standardize that so that we can make comparisons between, say, stock A and stock B, we're going to again go back to the analyst forecasts. Like we have 10 different forecasts for a particular stock in a particular quarter, right? We're going to calculate the standard deviation of those forecasts and then divide the difference between the average forecast and the actual earning per share that is announced by that standard deviation. Okay, this way we're calculating a standardized earnings surprise measure. Okay, once we do it, we're gonna sort stocks into, say, 10 categories by their earnings surprise, where the lowest category is going to contain the most negative surprises, and the highest category is going to contain the most positive surprises. And then what we're going to do, we're going to look at the returns of the portfolios of these 10 groups or 10 portfolios of stocks over time, see how their returns move. This is going to be what we'll find. So as you see, I'm calling these earnings surprise groups deciles. So going from deciles 1 to 10, you see this really, really interesting pattern in cumulative average excess returns. So this is basically the return after adjusting for the risk-free rate, um, summed up over time. So it's like a total return every period, starting from period negative 20 here, 20 days before the announcement. So sum them up, well, you see some patterns here. On the day of announcement, you see a jump. If it's a negative surprise, you see a jump up. You see a fall if it's a negative surprise. You see a jump if it's a positive surprise. So if the markets were efficient, you would expect, okay, that's going to move like that, right? It must have been a very flat line afterwards. But the thing is, you don't actually see it. What you see is something different, right? You basically see something going like, well, you would expect something like this. Let me make sure this works. Okay, so you would expect something like this, right? For the decile of 10, right? But that's not what's happening in the data. In the data, what's happening is that you see this upward pattern. And people actually use this to make money. So I've actually talked to portfolio managers whose one of important jobs is actually to sit down around the earnings announcement and do similar things and basically realize what stocks they want to buy more, what stocks they want to sell, right? And then they basically realize some money. Nonetheless, this is more of a concern for smaller stocks, but rather than larger stocks. But still, it's something important on the market. It's a very important anomaly. All right. So this is the fourth important major anomaly that we talk about. So just to summarize, we have the P/E ratio, we have the size anomaly, we have the book-to-market ratio anomaly, and then we have the post-earnings announcement drift anomaly. Okay. So these are the four anomalies that have been discovered, and there's a lot of active research going on to understand them. Okay, now there are two major ways that researchers interpret these things. So, in essence, the main question is what do these anomalies stand for? Well, we have two schools, as I said. So one is basically attributing all these anomalies to systematic risk, and that school basically is following from a French type of interpretation. They're going to say, well, we have this model that adds these factors to our basic CAPM, and then we get to improve our understanding of how returns vary over time and across stocks. That means that there are certain risk factors that we don't know yet, but we have identified some portfolios that are highly correlated with them, and as a result, we're able to basically explain part of the anomalies. So whatever's remaining would also represent some other risk factors that are unknown. So that's basically keeping our research question open, trying to find further risk factors that could explain that the deviations from CAPM in essence. But the other school is basically the openers of the gates of behavioral finance. They say, well, these are market inefficiencies. There are certain reasons why markets could be inefficient. So they basically, for example, say, well, what you see with post-announcement drift could be that these analysts are overly optimistic about their forecasts. In essence, they extrapolate the past performance a lot more than they should forward, and that's why what's going to happen is that the future performance is well lower than what they expect. Their extrapolations of the past performance are biased. They are overly optimistic, and this means that in the long run, the returns are going to go, for example, against what they think, right? Well, there are actually studies that sort of support this. For example, there are papers that show that in the long run, the low expected growth firms outperform those with high expected growth, right? which means that these analysts have their biased assessments of future performances of the firms. Okay, so this sort of debate led to studies that try to basically identify whether or not the discovery of these anomalies have actually impacted the investor behavior. And it looks like there is quite a bit of evidence that show that was so. Um, for example, Cordias, Abrahamian, and Tong had this argument that, okay, Fama French identified whatever anomalies they claim there is in 1993. It was publicized there. So let's see if the behavior of returns and investment volume, things like that, has actually experienced any change after 1993 compared to before. So what they did, they looked at the long time series of abnormal returns for before and after 1993. And then they focus on the previously mentioned abnormal returns, right? And they basically show that after 1993, the abnormal returns vanish, which somehow suggests that, well, investors were not aware of these systematic risks. After they became aware, they took them into account, trying to trade based on them, right? And as a result, whatever excess return existed went away, right? There is a more detailed and more accurate study here, McLean and Pentoff. What they did was, okay, there are different anomalies identified on different dates. Let's look at the exact date of identification of those anomalies, which would be basically the date where a research paper, a white paper, or whatever was first published or publicized in general, and people got to know of something that they didn't know before. So what they show is that the abnormal returns of whatever anomaly they're looking at, on average, falls by 35% compared to the pre-publication of the magnitudes of that same anomaly. Okay, they don't find disappearance; they just find a decline in the abnormal returns. They also show differences in trading activity patterns. They show that the trading volumes and volatilities rise after an anomaly becomes publicized, which is actually an important indicator of changes in trading behavior, or could be an indicator of changes in trading behavior, right? People get to know something and they try to correct for their investment decisions, which means that they're going to rebalance their portfolios, their holdings. As a result, there's going to be increase in volume. At the same time, because certain trading strategies are being followed, that's going to induce some volatility as well. Okay? So there are good research there that basically shows that these anomalies matter to investors, and investors actually take them seriously. All right. So, what if we basically take the other route that calls these anomalies market inefficiencies that persist, they don't go away, right? That means that if someone is in the industry, is an expert, right, and knows what's going on, they should be able to take advantage of these inefficiencies very well, right? So if they are inefficiencies, there should be people who make money off of the inefficiencies all the time, okay? And who are the best, I'll say, nominees for that sort of thing? So we can think of the analysts, right, because they're experts in a particular industry, for example. And also we can think of fund managers, right? Mutual funds are known to be investment managers, and they should be able to beat the market index, right? So we're going to look at two types of experts who have the knowledge and the resources to exploit market inefficiencies, if they are market inefficiencies. Now, in order to make the argument, we need to show that these experts consistently and persistently make money. That is, if you take a particular expert, the expert is able to realize abnormal returns over time, right, on a certain security or on a certain portfolio. That what we're gonna try to see whether is there. Okay, so let's start out with analysts. So on average, the very first observation that we see is that on average, these analysts are overwhelmingly optimistic about the future prospects of securities they monitor. Okay, so there's this standard data by Thomson Reuters provided where the analyst recommendations are coded into five quantities. Strong buy is coded by 1, buy coded by 2, null coded by 3, or the neutral, sell coded by 4, strong sell coded by 5. All right. So if analysts are eager on either side, they don't really prefer a certain side in terms of buy versus sell, the average should be something close to 3, right? But the actual average recommendation index is around 2, which means that most of their recommendations are around here, right? That means that they are overly optimistic. Okay, now that they're overly optimistic, do they actually make money off of these optimism? Right, that's the next important question. This is actually a good observation that gives us an opportunity to see whether they make money or they are able to help people make money. Nonetheless, this observation can pick up some neglected stock effect, right? So basically, analysts tend to issue strong buy for small stocks more often than strong sell. So basically, they are not interested in poorly performing stocks. That's the idea. So if there's a small stock there and it is expected to do well, that's the stock where an analyst would be interested in. You know, a terrible garbage type of stock is not interesting to an analyst. That's why they do not actually issue anything. They would remain null on those types of stocks. Okay, so once you look at the actual data, what you find is that a positive change in recommendation, for example, going from sell to strong sell, is followed by a 5% increase in prices, and a negative change, say going from null, for example, to sell, is followed by an 11% decrease in price. Okay, which means that, you know, once you average across all these analysts, they are right on average. They are correct in predicting what's going to happen with the stock. However, the level of recommendation is not consistent by analyst, right? So basically, you cannot find a certain analyst who is always able to, or on average, is able to make correct recommendations. So if you add analyst fixed effects, basically, you will not find anything for a particular analyst in terms of, you know, correct recommendations. But once you aggregate the analyst information or the analyst recommendation codes, then there is something to it. So it's basically a notion of collective wisdom that we see again here. All right, it's not the particular analyst that can make the dollar. So the recommendation of analysts typically represent permanent changes, right? So they are informative, right? So you know that there's going to be a change in price. But once you account for the trading costs, it really doesn't make sense on average to follow an analyst recommendation to buy or sell stock. Okay, because they issue all these buy sells all the time, right? But it's not clear whether trading costs are going to be low enough to make help you make money off of these trades. And actually, once you look at the data, you realize that trading costs are going to swamp the effective changes in prices due to analyst recommendations. So Thus, our indirect test of market efficiency using the analyst recommendations and the subsequent price changes tells us that markets are efficient. These guys are not able to help anyone make good money. The other test that we do is that we're going to look at the fund performances. So mutual funds have all these resources. They can actually enjoy very low trading costs, and they are actually also able to follow very, very tiny alphas because of that low trading cost and the fact that they have a lot of money. Okay. So instead of comparing the performance to the market portfolio, we're going to use the Fama-French four-factor model. The four-factor model contains the market index, size portfolio, book-to-market ratio portfolio, and the momentum factor. Right? The momentum factor is the return on the portfolio of past returns, portfolio that buys winners and sells losers. Sorry, users. And then we're going to estimate alpha based on this four-factor model, which basically incorporates the behaviors of fund managers who invest in small stocks as well as large ones, and they follow some momentum strategies too. So once we calculate the alphas off of all these mutual funds that are available out there, and then plot the histogram for these alphas, we're going to see something that is sort of skewed to the left, right? So we have a lot less mass here, but a lot more up here on the positive side. So there is a huge mass that is up here, meaning that the median of these alphas is actually greater than 0, which means that, okay, fund managers are doing something. They are delivering some non-zero alphas after all, okay? But they deliver this at some cost. So the investors are going to have to pay fees, right? And once you adjust for the fees, this distribution is going to shift to the left a little, so that this mass is going to basically shift around 0, and you basically end up with a conclusion that, adjusting for the fees, there's not much left. All right? So the fund managers are not able to create a value either. Okay? Now that we saw what happens on average with fund managers or the fund performance, the next question is, are there funds or managers that persistently beat the market in the risk factors? Okay. Are there certain market managers that can persistently deliver positive alpha? So in order to find that, we take a certain quarter and sort the funds from the largest alpha to that with the smallest alpha. And then we're going to look at the performance of that very funds next quarter, right? And then we're going to match the performances or alphas this quarter and next quarter. So if we did that for the current quarter, right, the ranking quarter, we're going to have like the best fund up here delivering an alpha of 4.3-ish. Sorry, it's like 4.7, my bad. And then the worst, it has some sort of a -5 alpha, right, 5% quarterly return. What happens to the exact same fund next quarter? So this best fund is going to go down to barely a positive alpha. It's really, really tiny. And the poor performing one improves to a barely negative alpha. Okay? In essence, the difference between the alphas in the ranking quarter is huge, right? It's about 10%, right? But the difference between the best and worst performing funds is less than 1%. Which basically leaves us with no strong evidence that managers persistently beat the market. So if you invest your money in a fund, in a certain fund, in the long run, you cannot expect to have to collect positive alphas because your manager is going to be good in some period and bad in the other. So this basically goes back to the notion of pure luck when you actually realize some non-zero alpha. All right, so all this together leaves us with a question. Are markets efficient? Well, this cartoon shows it all. All right, so this is something for you to entertain yourself with. Just think about what we have. Try to summarize what we got here. Next time, we're gonna finish up the course material by looking at the portfolio performance measures and how they're used and how they're interpreted in what circumstances, which measures we're gonna use, and then you guys should ready for the test. All right, I'll see you next week. And I hope that everybody watches this video before the next class. All right.